Hi, welcome back to the channel. My name is Joseph Gutierrez, and this is Covering Compounding. In today's video, we're going to investigate one of my favorite long-term investments and cash flowing assets, real estate. Real estate investing is one of those timeless assets that generates a total return that most other investment vehicles cannot remotely come close to. It pays us in a variety of ways and has been a staple asset that builds generational wealth for many. It's one thing to have active income that comes over in the form of a paycheck twice a month from the sweat of our brow. It's actually quite another thing to receive mailbox money month after month, year after year, just on something that we own and maintain. It also happens to pair perfectly with our favorite asset here on the channel, which I call the foundational asset, which is a high cash value life insurance policy, whether whole life or indexed universal life. We're all about assets here on the channel. The more assets that we own, the more options that we have. Now, in a later video, we'll show how I and some of my clients actively use their policy's cash value to fund and acquire other assets like real estate. That said, the focus of today's video is the 4 main ways that real estate investing pays us. All 4 ways build on each other to give us overall exceptional results. So let's get at it. Okay, how does real estate investing pay us and how is it different than other asset classes like stocks, gold, etc.? Well, the first way that real estate pays us is in appreciation, the value of the property going up in dollar amount over time. Now, there are 2 different forms of appreciation. One is general market appreciation, and the other is known as forced appreciation. Market appreciation, we have a steady increase in the value of the property over time. Now, to preface, when I talk about real estate investing, I'm mostly focusing on the commercial side, multifamily, 5+ units. Commercial real estate investing is better, in my opinion, for a variety of reasons, and one being how appreciation is calculated. We can increase the value of the property by obviously increasing rents. As time goes on, rents will naturally increase for a number of reasons. Migration patterns for jobs, inflation pressures pushing up asset prices, overall population growth. Now, whichever the reason, assuming that we aren't in a housing recession, we should expect that rents and by extension the value of the property to increase, usually on the order of 2 to 5% a year on average. The other way that we can cause appreciation is by improving the property as a whole. Now, we can add amenities like laundry center, we can lower average vacancy, lower the expenses, and overall have better property management. The better job that we do in managing the property and maximizing it, the better we will realize the full appreciation potential with the market. Now, this ties into the concept called forced appreciation. If we purchase a property that has lots of deferred maintenance, maybe old worn out appliances, flooring, then we can invest in updating the units. By updating the units, we can command a higher market rent per unit since they are in now nicer condition. Many investors only look for deals that have a forced appreciation aspect. Sometimes you'll hear the expression value add or upside potential. I often just call it looking for a deal with a little bit of hair on it. Either way you like to put it, forced appreciation is one of the most primary ways that shrewd investors create wealth. And because we're focusing on commercial, multifamily, real estate investing, the general calculus holds true for just about any deal. Take our gross income minus the average vacancy rate minus our expense rate, think property management, maintenance, taxes, groundskeeping, that kind of thing, which will leave us with the NOI or the net operating income. We then take our NOI for the year and divide it by the market cap rate, aka the capitalization rate. Now, every market has its own cap rate, which essentially says that if you bought for all cash, what would your annual yield on investment be? So we do all that math and we come up with our property value. If we manipulate any of the other variables, you can command a higher or lower price to sell or get a bank to finance against it. Now remember that commercial real estate is treated more as a business where profitability is a main concern. Okay, so the second way that real estate investing pays us is through debt paydown. Because real estate is one of the safest assets out there, banks love to lend against them. So we can get a loan in the 25 to 35% range to leverage our down payment money to buy a bigger property. And what's great about using debt to acquire the property is that our tenants regularly pay down our debt. In our basic calculation, our debt service is subtracted against the NOI. Year after year, the income from the property, from the rents, helps pay down our loan amount. In doing so, the total loan value decreases over time, which means that our overall equity in the property is also increasing over time. Couple that with general market appreciation, and we are accelerating our total wealth from the asset. Now, the third way that we build wealth through real estate investing is cash flow. Cash flow is the amount of profitability that we have from the yield of the investment. So naturally, cash flow is left over after we subtract our debt service. Unfortunately, cash flow is a metric that gets abused in the real estate investing world. New investors will often brag about their cash flow metrics, but after a year in the investment, the answer to the question, hey, does this cash flow?
Maybe. I don't know. Not really.
May be different. Many people overemphasize the cash flow expectation, which can land them into eventual hot water. There's an expression in real estate. People get into real estate investing for the cash flow, and people get out of real estate investing because of the cash flow. A year's amount of cash flow can easily get destroyed from unexpected vacancy, turnover, repair bills. If you've been in the game for any length of time, Murphy's Law always applies. Pipe freezes, holes in roof, replace water heater. Heck, one time one of my tenants got drunk, locked himself out, climbed the second story, and fell off the balcony, destroying it in the process. Moral of the story is cash flow is great, but it's best to consider it as residual income, at least for a time. It's basically a metric that doesn't really become significant until your equity position crosses the 50% mark anyways. Once your property equity appreciates that point, then the cash flow is real nice. Until then, it's best not to put too much weight on it, but it's still great to get that mailbox money every month. Now that brings us to our fourth and last way that real estate investing pays us, the tax benefits. Real estate, like many other businesses, have this concept called depreciation. This is where the IRS will allow us to write off a portion of the asset, the value of the asset, whether it's the structure of the building or something more basic like a heat exchanger. Those depreciable assets, which degrade over time, can be applied to your income on the properties to essentially write off the taxable nature of the net cash flow. It can actually also be applied to your active income from other sources like another business or W-2 income to lower your overall tax burden as well. Now, this is something that you would explore with your CPA or tax attorney, as we're not trying to give tax advice here, but the tax savings can be significant. Some investors, especially in less landlord-friendly states, buy property specifically for the tax write-offs and almost no other reason. There's a saying out there that if you're paying too much for taxes, you probably don't own enough real estate. It's very true and definitely something worth pondering over. Okay, thank you for watching. In today's video, we went over the 4 ways that real estate investing pays us and builds our wealth over time. We looked at appreciation, debt pay down, cash flow, and those tax benefits. Okay, all 4 of those come together to build exceptional returns that we don't necessarily see with other asset classes. Also, be on the lookout for our next video where we're going to be going over a hypothetical deal and utilizing our own desktop software that we use to go over the numbers to decide whether a deal is a good purchase or not. Remember, with real estate investing, the money is made on the buy, so it's very important to know your numbers. In that video, we'll also show you how you can get a free copy of our desktop deal analysis tool so that you can utilize it to take down your next apartment complex, your next piece of real estate to build you and your family's wealth. Okay, thank you again for watching. Feel free to click like and subscribe. Ring the bell for future notifications on our next content coming up. And I look forward to seeing you on our journey towards financial independence utilizing the foundational asset. Until next time.